Tax buckets. So there are three main tax buckets, and I'd like to describe those to you in detail. As you read in the text, I did an example of, it was a metaphor of a crop growing. So the first tax bucket is the pre-tax retirement account. The second tax bucket is the after-tax retirement account. And the third tax bucket is the non-retirement or taxable account that kind of is brokerage account money and all that type of stuff. So the first bucket, the pre-tax retirement account. This account type has things in it like your IRAs and your 401ks. Most of your retirement accounts at work are going to be on the pre-tax side. Now what that means is whenever you switch jobs or anything you might be doing, as long as you move money from a pre-tax bucket to another pre-tax bucket, then it should go tax deferred and not cost you any taxes when you roll or transfer money between the buckets. So all these buckets should be able to coexist, intermingle between each other. The same with the after-tax and the same with the non-tax retirement buckets. So, and that's the idea. When you're trying to combine them, as long as you stay in the same lane, then you're not going to have any type of, you shouldn't have tax consequences for staying within the same lane. But whenever you try to switch lanes, whenever you try to move money from a pre-tax retirement account into an after-tax retirement account, then you're going to have some tax issues that come into play. So again, pre-tax retirement, that's your IRAs and your 401ks and things of that nature. So, you know, in the text I described that if you put money into that, so a contribution would be adding money to that, you get a benefit. So you get a benefit right away, and that benefit is in the form of a tax deduction. So tax deduction, in the prior section we described, that's when, like, let's say if you made $100,000 one year and you put $5,000 into a pre-tax retirement account, the government says you didn't make $100,000, you made $95,000. So it just comes right off the top. That's a tax deduction. So with a pre-tax retirement account, you're getting that benefit on the seed, on the contribution itself. All right, so as that plant grows, as your account grows, it grows tax deferred. Now that's tax deferred growth. That means any buying, selling, exchanging of the investments inside the account doesn't get taxed then. It gets preferential treatment and it grows tax deferred. So no tax at the beginning, no tax on the way up. However, when you get to retirement and you start withdrawing from any pre-tax retirement account, you're going to be taxed on the withdrawal. And that tax is going to be in the form of an ordinary income. So ordinary income taxes. So that's like if, let's say in retirement, if you've made $40,000 just on various things and you take $10,000 from an IRA or a 401k or any other type of pre-tax account. So you were making 40, you took 10 out. The government says you didn't make 40, you made 50. So it just adds it right back on the top. So that's the way you get to tax deduction in the beginning and gross tax deferred. But at the end, eventually the entire account is subject to taxation. And there's even other rules when you get into your 70s where the government actually wants to make you start taking money out of the account. It's called required minimum distributions, which we'll explain those in more detail in a later section. All right, so that's pre-tax. The second one, the after-tax retirement account. This one is anything with the word Roth on it. So you got your Roth IRA, you got a Roth 401k. Sometimes you got after-tax 401ks, but they kind of work the same way. So after-tax retirement accounts work like this. You don't get a tax deduction on the seed. So if you made $100,000 and you put $5,000 into a Roth IRA or a Roth 401k, the government says, you know, we recognize that you put the $5,000 into your account. However, you don't get any benefit today. So the money goes in after tax. You don't get a tax deduction today. So no tax deduction, no benefit on the seed. Again, your crop's going to grow tax deferred, no taxes on the way up. You can buy and sell, change your mutual funds all you want to, and no taxes will be due. Pretty cool. Even better though, when you retire, as long as other conditions are met, meaning as long as you're after 59 and a half and a few other things that I'll mention in later sections, that all the gains, all the growth from that account should be tax-free. So that means that if you put in your $5,000 and if it grew to potentially $20,000 or more, that entire $15,000 of gains, that is entirely tax-free, potentially on the Roth side, as long as you satisfy those other conditions. So no benefit at the beginning, but a benefit at the end, where on the pre-tax you got the benefit at the beginning, but you got to pay taxes on the crop at the end. So those are the two differences between your sort of your regular IRAs and your Roth IRAs. And once again, the third bucket, that's your leftover money. That's like brokerage account money. You may have a joint account with your spouse, and that's going to be your taxable money. So that money, you got to be really concerned about things like capital gains. It does not get tax deferred growth. What that means is whenever you buy and you sell, you got to pay attention to what you paid for the buy and what you sold it for. And if you sold it for a gain, then you got to pay tax on that difference. And if you sold it for a loss, you get to deduct maybe some of that difference. But you got to keep up with a lot more stuff, which we've described in other sections in the form of cost basis and things like that. But that's the three tax buckets. And what I like to do is I like to practice tax diversification. So many of you may be diversifying. You've heard of diversification with your investments. So that means spreading your investments around in different items. So we haven't gotten to the investment section yet, but diversification is basically just not putting all of your eggs into one basket. Now, tax diversification kind of works the same way. So you're not going to put all of your investments into any one particular account bucket or tax bucket. So I like to have kind of a representation from all three if you can, because later in life when you retire, then you've got some representation from them, and it could be more advantageous in certain years, depending on what your income is, to take from the pre-tax bucket, or to take from the after-tax bucket, or to take from the non-retirement bucket. So tax diversification is a concept that I like to have representing in the accounts, but I look forward to sharing some more with you as we go along through the account types in this lesson.